Ever wondered how equity trading works or what it even is? Well, let's demystify it. In the simplest terms, equity trading is a type of financial market trading where investors buy and sell shares or stocks of companies. These shares represent a portion of the company's ownership. So, when you're buying shares, you're essentially buying a piece of that company. The primary purpose of equity trading, to make a profit, of course. Investors purchase shares with the expectation that their value will increase over time, providing a return on the initial investment. It's a bit like buying a promising seedling, nurturing it, and then selling the fully grown plant for a profit. Equity trading plays a pivotal role in finance, helping to shape economies and providing a platform for companies to raise capital. It's a dynamic, ever-evolving world with various strategies and types of trading. Now that we've set the foundation, let's delve into the different types of equity trading. First up, we have day trading. This is a rapid-fire style of trading where stocks are bought and sold within the confines of a single trading day. The aim is to make quick profits from small price fluctuations. It's fast-paced, adrenaline-fueled, and requires a keen eye for detail, as well as a strong understanding of the market. However, with the potential for quick returns comes a high level of risk. You could make a fortune, or you could lose one. Day trading is all about speed and timing. But what if you want to hold on to your stocks for a little longer? This brings us to swing trading. Delving into this realm, traders hold on to stocks for several days or weeks, basing their trades on the ebb and flow of price trends and market conditions. The potential here? Larger profits. But as with all things trading, it's a balancing act. The scales can tip towards increased risk due to the unpredictable nature of market volatility. So, as a swing trader, you'll need a keen eye on market trends. But what if you're in it for the long haul? For those with patience, there's long-term investing. This method involves buying stocks and holding on to them for years or even decades, with the expectation that the value will increase over time. It's like nurturing a seed into a full-grown tree. The benefits? Well, there's the potential for substantial growth and the bonus of lower transaction costs. You're not constantly buying and selling, so you avoid those pesky fees. Long-term investing is a marathon, not a sprint. But what if you want more flexibility? Finally, we have options trading. This is a strategy where investors enter into an agreement, earning the right to buy or sell a particular stock in the future. However, they are not obligated to follow through. This approach can offer the potential for high profits given the right circumstances. Yet, it's important to remember that the complexity and risk involved in options trading are considerably high. So, while options trading can offer flexibility and potentially lucrative opportunities, it's certainly not a game for the faint-hearted. So, there you have it, the different types of equity trading. Day trading wraps up within a single day. Swing trading holds stocks for a few days or weeks. Long-term investing involves holding stocks for several years. And options trading offers the right to buy or sell stocks in the future. Each has its own characteristics, potential benefits, and risks. It's like a buffet table. You pick what suits your appetite. Remember, each type of equity trading has its own risks and rewards. Choose the one that best aligns with your financial goals and risk tolerance.